Hello everyone, welcome to the 204th episode of me learning how to trade in Forex. So in the last episode, we went through the, what's it called? I think we went through the previous lesson actually, so Forex Trading Beginner's Guide. I remember doing the, what is it called? Scams, frauds, and hooksters. So we were going through that. We went through some of the notable scams in Forex trading, some tips for avoiding Forex scams. So verify broker credentials, be skeptical of high returns, do your research, and use security tools. How much capital you need to start trading Forex. So it can start off as little as 1,000 in a micro account, but we will need significantly more capital for a standard account. So leverage allows you to trade with larger capitals than you currently control, and the specific minimum deposits would depend on the brokerage you use and the amount of leverage they allow. So our Forex market is volatile, among the most liquid markets in the world, so they can be less volatile than other markets such as stocks. So volatility of a particular currency is a function of multiple factors such as the politics and economics of its country. Therefore, events like economic instability in the form of payment default or imbalance in trading relationships with another currency can result in a significantly volatility. Are Forex markets regulated? Forex trade regulation depends on the jurisdiction. So in the US, for example, there's the National Futures Association and the CFTC, and then there's the Financial Conduct Authority in the UK. Which currencies can I trade in? So currencies of high liquidity have a ready market and exhibit smooth and predictable price action in response to external events. USD is one of the most traded currencies in the world, and it's paired up in 9 of the world's 10 most traded currency pairs. Currencies with low liquidity cannot be traded in large lot sizes without significant market movement being associated with the price. Bottom line, so aspiring Forex traders should start with a solid foundation of education, practice demo accounts that only risk capital can afford to lose, partnering with a reputable, well-regulated broker and maintaining realistic expectations are also crucial. And to succeed in Forex trading, you must develop a deep knowledge of markets, economic fundamentals, and technical analysis. Managing risk is essential, which includes proper position sizing and stopping losses. And then we went through the getting started in Forex. So choosing a Forex broker, look for lower spreads, choose a broker who is backed by regulatory agencies and reliable institution, get the tools you need to succeed, and don't always leverage your bets. Choose a broker with an appropriate leverage tools and services for your capital. Forex broker actions to avoid: the sniping and the hunting, suspect margin rules, and then define your methods of analysis, so technical analysis and fundamental analysis. Went through what the fundamental analysis is, and then technical analysis. Develop your trading strategy, so develop a strategy and perfect it over time. So your strategy can focus on one particular study or calculation, or use a broad spectrum analysis to determine your trades. So you try to use a combination of both fundamental and technical analysis in order to make long-term projections and determine short-term entry and exit points. Some added considerations: open a demo account and paper trade until you can make a consistent profit. Trade without emotion, and the trend can be your friend. We're going to carry on with what is Forex trading. So what is Forex trading? Forex trading is exchange or trading of currencies on the foreign exchange market. Trading occurs in currency pairs such as the EUR-USD, the Euro versus the US dollar, and the USD-CAD, the US dollar versus the Canadian dollar. The foreign exchange market is the most actively traded market in the world. What does the spread represent? The spread is the difference between the price at which you can buy a currency pair and the price at which you can sell it. The spread is what's quoted for traders. More liquid markets such as Euro-USD will have narrower spreads than the less liquid markets. A spread is also one way that a forex broker makes money. The spread the trader pays the broker is more than the spread the broker will in turn pay when placing the trade. What's a forex demo account? It's an account offered by some firms that let traders and investors test out their trading or investing skills in a no-pressure atmosphere without real money. Demo account lets you simulate real trades and test strategies without the fear of actual financial loss. You also have the chance to get used to the broker's trading platform technology. Beginning and experienced traders and investors use demo accounts. Bottom line, the Forex market is the largest financial market in the world with a daily volume of 6.6 trillion. I thought it was 7 point something. Individuals have become increasingly interested in earning a living trading foreign exchange. However, there's a lot to consider before you begin trading. You want to be sure that your broker meets certain regulatory and financial criteria. You need to find the right trading strategy for your objectives. Bear in mind that one way to learn to trade Forex is for demo accounts. Use one to practice trading until you're confident enough to use real funds. Cool. Next up, basics. How currency trading works. So still Investopedia. How currency trading works. 20 seconds. What's different about the Forex markets? Trading in any investment market is very difficult, as evidenced by the fact that most beginning traders lose money. However, success can be found with enough of the right education, practice and experience. So what is currency trading, and is it right for you? The currency market, or Forex FX, is the largest investment market in the world and continues to grow annually, with more than 4 to 5 trillion in notional value exchanged daily. In comparison, there's only $25 billion of daily volume on the New York Stock Exchange. The market may be large, but until recently the volume came from professional traders, but as currency trading platforms have improved, more retail traders have found Forex to be suitable for their investment goals. Key takeaways. Forex exchanges allow for 24/7 trading in currency pairs, making it the world's largest and most liquid asset market. While it is the largest market in the world, a relatively small number, around 20 of currency pairs are responsible for the majority of volume and activity. Currencies are traded against one another's pairs, e.g. Euro-USD, and each pair is typically quoted in pips, percentage in points, out of 4 decimal places. Currency prices fluctuate based on the economic situation of the countries involved, geopolitical risk and instability, and trade and financial flows, among other factors. So how does currency trading work? Currency trading is a 24-hour market that is only closed from Friday evening to Sunday evening, but the 24-hour trading sessions are misleading. There are 3 sessions that include the European, Asian and United States trading sessions. Although there is some overlap in the sessions, the main currencies in each market are traded mostly during those market hours. This means that certain currency pairs will have more volume during certain sessions. Certain currency pairs will have more volume during certain sessions. Traders who stay with pairs based on the dollar will find the most volume in the US trading session. So New York, Forex hour, market hours in GMT. Pairs and pips. All currency trading is done in pairs. Unlike the stock market, where you can buy or sell a single stock, you have to buy one currency and sell another currency in the Forex market. Next, nearly all currencies are priced out to the 4th decimal point. A pip, or percentage in point, is the smallest increment of a trade. 1 pip typically equals to 1 out of 100 of 1%. 100th of 1%. Currency is traded in various size lots. Micro lot is 1,000 units of a currency. If your account is funded in US dollars, micro lot represents $1,000 of your base currency, the dollar. Mini lot is 10,000 of your base currency, and a standard lot is 100,000 units. A pip, percentage in point, is the smallest increment of trade. 1 pip typically equals 1 out of 100 of 1%, or the number in the fourth decimal point. Most currencies are priced out to the fourth or fifth decimal point. Exceptions to this rule are currency pairs that include the JPY as a quote currency. These pairs typically price out to 2 or 3 decimal places, with a pip being represented by the second decimal place. Isn't there like a pipette as well? I think we've seen like a pipette which is like the 5th decimal place. Retail beginning traders have often trade currencies in micro lots, because 1 pip in a micro lot represents only a 10-cent move in the price. This makes losses easier to manage if a trade doesn't produce the intended results. In a mini lot, 1 pip equals to $1, and that same 1 pip in a standard lot equals $10. Some currencies move as much as 100 pips or more in a single trading session, making the potential losses to small investors much more manageable by trading in micro or mini lots. Far fewer products. The majority of the volume in currency trading is confined to only 18 currency pairs compared to the thousands of stocks that are available in the global equities market. Although there are other traded pairs outside of the 18, the eight major currencies most often traded are the USD, CAD, EUR or Euro, GBP, CHF, NZD and AUD, and the JPY. Although nobody would say that currency trading is easy, having far fewer trading options makes trade and portfolio management an easier task. What moves currencies? An increasing amount of stock traders are taking interest in the currency markets because many of the forces that move the stock market also moves the currency markets. One of the largest is supply and demand. When the world needs more dollars, the value of dollar increases, and when there are too many circulating, the price drops. Other factors like interest rates, new economic data from the largest countries, and geopolitical tensions are just a few of the events that may affect currency prices. Why is the currency trading called Forex or FX? Forex is an abbreviation of foreign exchange, as in FX. These terms are common shorthand for currency trading. Who invented currency trading? The exchange of foreign currencies goes back to the early human civilization and the advent of trade routes and commerce. However, modern forex trading effectively began in 1973 when the gold standard of foreign exchange was abandoned and the free-floating currencies were adopted. Gold standard of foreign exchange was abandoned and the free-floating currencies were adopted. How are currency pairs quoted? Currencies are traded in pairs so that in every trade one currency is exchanged for another at a given rate, determined by the market. These pairs look something like Euro USD equals 1.08. This means that 1 euro buys 1.08 US dollars. The base currency appears first and the quote currency or counter currency second. In a direct quote, the quote currency is a foreign currency, whilst in an indirect quote, the quote currency is domestic currency. Okay, so in a direct quote, the quote currency, so USD is a foreign country, while in an indirect quote, the quote currency is domestic currency. Direct quote is a foreign exchange rate quoted in fixed units of foreign currency in variable amounts of the domestic currency. In other words, a direct currency quote asks what amount of domestic currency is needed to buy 1 unit of the foreign currency. This can be contrasted with an indirect quote in which the price of domestic currency is expressed in terms of foreign currency. The European Central Bank, which oversees the conversion, intended the currency to be financial markets' dominant currency. It specified that the euro should always be the base currency whenever it is traded, including against both the USD and the GBP. For this reason, quotes are always the number of dollars, pounds, Swiss francs or Japanese yen needed to buy 1 euro. Major exception to the dollar-based quote rule is when the GBP is quoted against other currencies, including the dollar, but with the exception of the euro. This reflects the fact that the pound was the world's dominant currency in the years leading up to World War II and before the ascendancy of the US economy. The exchange rate for the pound would thus be quoted as $1.45 per £1, regardless of whether this is considered direct in the United States or indirect in the United Kingdom. The USD is the most actively traded currency in the world. In the context of trading rooms and professional publications, most currencies are quoted as a number of foreign currencies per dollar. This means the dollar serves as the base currency, whether the speaker is in the USA or elsewhere. Example of a direct quote using USD might be stating 1.17 CAD per USD, rather than 85 US cents per CAD, which would be an indirect quote. Basically, who comes first, which currencies are base currency and which currencies are quote currency, so the order of them. Bottom line, much like anything in the investing market, learn about currency trading is easy, but finding the winning trading strategies take a lot of practice. Most Forex brokers will allow you to open a free virtual account that allows you to trade virtual money until you find the strategies that will help you become a successful Forex trader. Investopedia does not provide tax, investment, or financial services and advice. The information is presented without consideration of the investment objectives, risk tolerance, or financial circumstances of any specific investor and might not be suitable for all investors. Investing involves risk, including the possible loss of capital. Principle. Okay, so that's done. Basic Forex overview. Next up, currency pairs. What amounts of domestic currency is needed to buy 1 unit of the foreign currency? What amount of domestic currency is needed to buy 1 unit of foreign currency? Indirect quote. What is the amount of domestic currency received when 1 unit of foreign currency is sold? What amount of domestic currency is received when 1 unit of foreign currency is sold? What amount of domestic currency is received when 1 unit of foreign currency is sold? What is a currency pair? Major, minor, and exotic examples. What is a currency pair? Major, minor, and exotic examples. So what is a currency pair? Major, minor, exotic examples. Currency pair is a quotation of 2 different currencies, with the value of one currency being quoted against the other. The first listed currency of a currency pair is called a base currency, and the second currency is called a quote currency. Currency pairs compare the value of one currency to another, the base currency or the first one versus the second of the quote currency. Indicates how much of the quote currency is needed to purchase 1 unit of the base currency. Currencies are identified by an ISO currency code or the 3-letter alphabetic code they are associated with on the international market. So for US dollar, the ISO code would be USD. Key takeaways. Currency pairs a price quote of the exchange rate for 2 different currencies traded in the FX markets. When an order is placed for a currency pair, the first listed currency or base currency is bought, while the second listed currency in a currency pair or quote currency is sold. The Euro-USD currency pair is considered the most liquid currency pair in the world. The USD-JPY is the second most popular currency pair in the world. Currency pair. The price quote for the exchange rate for 2 different currencies traded in the FX markets. Understanding currency pairs. Trading currency pairs is conducted in the foreign exchange market, also known as the Forex market. It is the largest, most liquid market in the financial world. This market allows for the buying, selling, exchanging, and speculation of currencies. Also enables the conversion of currencies for international trade and investments. The Forex market is open 24 hours a day, 5 days a week, including most holidays, and sees a huge amount of trading volume. All Forex trades involve the simultaneous purchase of one currency and the sale of another. but the currency pair itself can be bought off as a single unit, an instrument that is bought or sold. But the currency pair itself can be thought of as a single unit, instrument that is bought or sold. When you buy a currency pair from a forex broker, you buy the base currency and sell the quote currency. Conversely, when you sell the currency pair, you sell the base currency and receive the quote currency. Currency pairs are quoted based on their bid, which is a buy, and their ask, which is their sell prices. The bid price is the price that the forex broker will buy the base currency from you in exchange for the quote or counter currency. The ask, also called the offer, is the price that broker will sell you the base currency in exchange for the quote or counter currency. When trading currencies, you're selling one currency to buy another. Conversely, when trading commodities or stocks, you're using cash to buy a unit of that commodity or a number of shares in particular stock. Economic data relating to currency pairs, such as interest rates and economic growth or gross domestic product, affect the prices of a trading pair. So we've got the major currency pairs. A widely traded currency pair is the euro against the USD, or shown as EUR-USD. In fact, it's the most liquid currency pair in the world because it is the most heavily traded. The quotation euro-USD equals 1.25 means that 1 euro is exchanged for 1.25 USD. In this case, the euro is a base currency and USD is a quote currency, counter currency. This means that 1 euro can be exchanged for 1.25 US dollars. Another way of looking at this is that it will cost you $125 to buy 100 euros. There are as many currency pairs as there are currencies in the world. Total number of currency pairs that exist changes as currencies come and go. All currency pairs are categorized according to the volume that is traded on a daily basis for a pair. The currencies that traded the most volume against USD are referred to as the major currencies, which include Euro USD or Euro versus the US dollar, USD's JPY or dollar versus the yen, GBP USD or the British pound versus the dollar, USD CHF or the Swiss franc versus the dollar, AUD USD or the Australian dollar versus the US dollar, USD CAD or the CA Canadian dollar versus the US dollar. Final two currency pairs are known as the commodity currencies because both Canada and Australia are rich in commodities and both countries are affected by their prices. The major currency pairs tend to have the most liquid markets and trade 24 hours a day, Monday through Thursday. Currency markets open on Sunday night and close on Friday at 5 PM US Eastern Time. Final two currency pairs are known as the commodity currencies because both Canada and Australia are rich in commodities and both countries are affected by their prices. So AUD /USD and USD CAD are known as the commodity currencies because both Canada and Australia are rich in commodities, and both countries are affected by their prices, Just to remind myself, commodities is like oil, wheat, cattle, that sort of thing, right? Commodities. Physical assets that are consumed and used by people, animal industry, easy, oil, gold and wheat. Yep, cool. The currency market open on Sunday night and close on Friday at 5 PM US Eastern Time. Close on Friday 5 PM US Eastern Time. Minors and exotic pairs. Currency pairs that are not associated with the USD are referred to as minor currencies or crosses. These pairs have slightly wider spreads and are not as liquid as the majors, but they are sufficiently liquid markets nonetheless. Currency pairs that are not associated with the USD are referred to as minor currencies or crosses. Slightly wider spreads are not as liquid as the majors, but they are sufficiently liquid markets nonetheless. The crosses that trade the most volume are among the currency pairs in which the individual currencies are also majors. Some example of crosses include the Euro GBP, GBP JPY, and Euro CHF. Exotic currency pairs include currencies of emerging markets. These pairs are not as liquid and the spreads are much wider. Example of an exotic currency pair is a USD SGD, US dollar, Singapore dollar. Okay. Pips. What are pips in Forex? What are pips in Forex trading, and what is their value? So, what is a pip? A pip is the smallest whole unit price move that an exchange rate can make. Based on Forex market convention, a pip is 1/100th of 1%, so 1 over 100 times by 0.01, and appears in the fourth decimal place, so 0.0001. Most currency pairs are priced out to 4 decimal places, and a single pip is in the fourth decimal place, i.e. 1 over 10,000th. For example, smallest whole unit move the USD CAD currency pair can make is 0.0001 or 1 pip. Pips used in Forex trading should not be confused with BPS, basis points, which are used in interest rates markets that represent 1 over 100th of 1%, i.e. 0.01%. Key takeaways: Forex currency pairs are quoted in terms of pips, short for percentage in points. In practical terms, a pip is 1/100th of 1%, so 1 out of 100 times by 0.01, and appears in the fourth decimal place, 0.0001. It is the smallest price change increment for most Forex pairs. The bid-ask spread of a Forex quote is typically measured in pips. So understanding pips: a pip is a fundamental concept of foreign exchange. Forex traders buy and sell a currency whose value is expressed in relation to another currency. Quotes for these Forex pairs appear as bid and ask spreads that are accurate to 4 decimal places. Movement in the exchange rate is measured by pips. Since most currency pairs are quoted to a maximum of 4 decimal places, smallest whole unit of change of these pairs is 1 pip. Pip is an acronym for percentage in points or priced interest point. Priced interest point. Calculating pip value. Pip's value depends on the currency pair, the exchange rate, and the trade value. When your Forex account is funded with USD, the USD is a second of the pair or the quote currency. Such as with the Euro USD pair, the pip is fixed at 0.0001, quote currency. In this case, the value of 1 pip is calculated by multiplying the trade value or lot size by 0.0001. So for the Euro USD pair, multiplying a trade value of say 10,000 euros by 0.0001, pip value is $1. If you bought 10,000 euros against the dollar at 1.0801 and sold it at 1.0811, you make a profit of 10 pips or $10. Value traded times by quote currency pip equals pip value. If the USD is the first of the pair or the base currency, such as with the USD CAD pair, pip value also involves the exchange rate. Divide the size of a pip by the exchange rate and then multiply by the trade value or lot size. So trade value times by pip size divided by exchange rate is equal to pip value. For example, 0.0001 divided by a USD CAD exchange rate of 1.2829 and multiplied by a standard lot size of 100,000 results in a pip value of $7.79. If you bought 100,000 USD against the CAD at 1.2829 and sold at 1.2830, you make a profit of 1 pip or $7.79. $7.79. JPY exception. Japanese yen pairs are quoted with 2 decimal places, marking a notable exception to the 4 decimal place rule. For currency pairs such as the Euro JPY and the USD JPY, the value of a pip is 1 over 100 divided by the exchange rate. For example, if the Euro JPY is quoted as 132.62, 1 pip is 1 over 100, which is something, I can't work it out, 1 divided by 100, you just need to go 2 decimal places, so 1 to 0.01, divide by 132.62, which is 0.100000754. With a lot size of 100,000 euros, the value of 1 pip in USD would be $7.54. But I thought we talk about JPY here. How come we got euros and dollars together now? Yeah, Euro JPY. Why is there a USD figure in here? Must be a typo. Fast fact, fractional pips are smaller than pips and thus more precise measurement. They may appear as a superscript numeral at the end of a quoted exchange rate, or as a 5th digit to the right of the decimal point, or 3rd digit on the yen pairs. The fractional pip or pipette is 1/10 of a pip, even though traders may also refer to it as a pip, which can be unnecessarily confusing. Pips and profitability. The movement of the exchange rate of a currency pair determines whether a trader makes a profit or loss at the end of the day. Trader who buys the Euro USD will profit if the Euro increases in value relative to the USD. If the trader bought the Euro for 1.1835 and exited the trade at 1.1901, they will make 66 pips on the trade. So 1.1901 minus 1.1835. Now consider a trader who buys the JPY by selling the USD JPY pair at 112.06. Trader loses 3 pips on the trade if they close out the position at 112.09. They profit by 5 pips if they close it out at 112.01. While the difference may look small in a multi-trillion-dollar foreign exchange market, gains and losses can add up quickly. For example, on a $10 million position that closed at 112.01, the trader will make 500,000 in USD. That's $4,463.89. So, oh no, they will make 500,000 yen in USD. That's $4,463.89 from 10 million position. Real world examples of PIP. A combination of hyperinflation and devaluation can push exchange rates to the point where they become unmanageable. In addition to impacting consumers who are forced to carry large amounts of cash, this can make trading unmanageable and the concept of a PIP loses meaning. A combination of hyperinflation and devaluation can push exchange rates to the point where they become unimaginable. In addition to impacting consumers who are forced to carry large amounts of cash, they can make trade unmanageable and the concept of PIP loses meaning. Right, so a well-known historical example of this occurred in Germany's Weimar Republic when the exchange rate collapsed from its pre-World War I level 4.2 marks per dollar to 4.2 trillion marks per dollar in November 1923. Another case in points is the Turkish lira, which reached a level of 1.6 million per dollar in 2001, which many trading systems could not accommodate. The government eliminated 6 zeros from the exchange rate and renamed it to the new Turkish lira. As of February 2024, the average exchange rate was 0.032 lira per dollar. So what's a pip? Pip is the smallest unit of measurement of the differences between the bid and ask spread in a foreign exchange quote. A pip equals 1 out of 100th of 1%, or 0.0001. Thus, the Forex quote extends out to 4 decimal places. Smaller price increments are measured by fractional pips or pipettes. What's the difference between a pip and a pipette? In the context of foreign exchange markets, a pip is a standard unit of measure for changes in the exchange rate, representing a move of 0.0001. 1 over 10,000th. This is the smallest price change increment for most currency pairs. Pipette equals 1 out of 10, a tenth of a pip, and represents a fraction of 1 over 100,000. Pip therefore relates to the movement in the fourth decimal place, while a pipette is used to measure movement in the fifth decimal place. Definition of pip is the smallest whole unit measurement of the difference between the bid and ask spread in a foreign exchange quote. What's the difference between a pip and a pipette? Context: a pip is the standard unit of, I think we've gone through this. Pip therefore relates to the movement of the fourth decimal place, while a pipette is used to measure movement in the fifth decimal place. How are pips used? They are part of a currency pair's exchange rate market price. Pips represent the change in the quote and value of a position in the markets you may have taken. Say, hypothetically, you bought a currency pair for 1.1356 and sold it for 1.1360. You made 4 pips on your trade. You would have to then calculate the value of a single pip and multiply that by your lot size for the dollar value of your profits. Okay, so does the JPY Forex rate use pips? Yes, it does. However, the yen is an exception. A quote for the yen normally extends 2 decimal places past the decimal point. So a single whole unit pip is 0.01 rather than 0.0001 used in the other currencies, using the other currency pairs. What is the spread in a Forex? The Forex spread is the bid price subtracted from the ask price of a currency pair. For example, if Euro USD has an ask price of 1.1053 and a bid price of 1.1051, then the spread is 0.0002 or 2 pips. To calculate the cost of the Forex spread, you need to multiply the spread by the trade size or volume. For example, if you trade 100,000 units of Euro USD with a 2 pip spread, then the cost of the spread is $20 because it is 0.002 times by 100,000. Bottom line, the concept of pips is a fundamental in Forex market and serves as a significant basis for making trading decisions. A pip is a basic measure used in the Forex market for currency movements. It is typically the smallest price move that a given exchange rate makes based on the market convention. Understanding pips is crucial for Forex traders as it allows them to quantify the value of their potential gains or losses and manage their leverage and risk accordingly. Interest rates, which I will be leaving for the next episode. See you guys then. Peace.